Welcome to Beat the Markets.
I'm Ritger.
And I'm DKM. So, in our pilot episode, we touched on a lot of topics. I think one of the big things we could take away from it is the notion of diversification, how it's effective in beating the markets, and really anybody can do it. The thing though is, it took me a long time to really appreciate diversification. I always thought of diversification as this. There's only one thing that's number one in the market, right? There's always one asset class that's beating everything. So if you're telling me to diversify, you're forcing me to accept mediocrity and put in a lot of other stuff that's not great in there. Why is that thinking wrong?
Well, it's awful hard to get that big headline number in reality. When putting together a real world portfolio that you can stick with, you can't just go all into one thing, because you'll trade in and out, you'll do it wrong, and you got to pick the right thing.
So this was a big light bulb that went off for me in terms of, if we just look at the S&P 500.
Right.
So when I was younger, I was always thinking, well, hey, I'm always gonna pick the number one asset class. I had dreams. In the 70s, I would have been in gold. In the 80s, I would have been in Japanese equities. In the 90s, I would have been in NASDAQ. And in the 2000s, I'd be right back in gold. And each decade, you tenfold your money. And with $10,000, it goes to 100,000 to a million to 10 million. And I'm a winner.
I mean, if you compound it like 25% for your life, you own the entire planet. You're a mega trillionaire. So
that's an unbelievable point of how much wealth you gain just by compounding, even at 10, 11, 12. It doesn't sound like a lot.
No, 6 is enough. If you compound for 6 for your life and you save at some reasonable rate, you can retire happy.
So do you know this? Did you know this? You know this old story of how the Dutch bought the island of Manhattan from the Indians for $24 worth of trinkets in the 1600s?
Yeah.
So if you compound, so if the Indians could take that $24 that they got, monetize it, and invest at only 6% for the 1600s,
a lot of compounding.
It's more than the island of Manhattan's worth today.
I can believe it. The long-term return on real estate is only 2% real.
That's right. That's right. So that's one aspect, right?
No property taxes.
And no property taxes, and no capital contribution, right? To build Manhattan required a lot of capital infusion also.
Insurance, you're getting sued by your tenants.
It shows you how difficult it really is to compound at 6% over that time frame.
Yeah.
And how, even if you're getting an 11, 12, 13%.
You don't have to shoot the lights out. You just need some reasonable rate of return, and you need to actually get it.
So that's the thing, right? Is to really be in gold in the 70s, be in Japan in the 80s, be in NASDAQ in the 90s, to get it right, and be in the number one asset class each decade is difficult.
Nobody's done it.
No one's done it, or no one. But anybody can diversify and capture these returns that the market offers.
That's right. It's easy.
So you want to spend a little bit of time showing us diversification in action?
Yeah, let's jump into a little demonstration. It always helps to have charts.
All right, so maybe we turn the lights off and take a look at what you got here for us.
All right, so here I put together a demonstration of what would have happened over the last 20 years with 3 different diversified portfolios. This first one up top, we're calling the pseudo-diversified portfolio. And this is a portfolio that we see a lot of. When we get a new client and we look at their existing accounts, it's usually some jumble of mutual funds, usually completely U.S. stocks, or at least overwhelmingly U.S. stocks. And they're diversified, right? Because they have some big cap, some growth, some small cap, some value, mid cap, what have you, different flavors, but they're all stocks, and they're heavily US centric. So I call that pseudo-diversification because, as we see, mixing up a lot of different stock sectors doesn't do very much for you. But you don't want to go whole hog into just energy or just healthcare, or certainly not just gold miners, but you can do better. So these other two portfolios are what you call proper asset allocation portfolios, where you delve into other asset classes besides stocks. So an asset class, your asset classes are stocks, bonds, real estate, and commodities, and maybe currencies, depending on how you classify them. But so this first one we'll look at is a really crude portfolio. But it's crude, it's simple, but it's effective. This was invented by Harry Browne, who people know as a libertarian candidate for president. He came up with this idea after the experience of the late 1960s through the early 1980s, really what we know as the 70s, which was a horrible period for investors. Stocks, the Dow hit 1,000 in 1966, and it was still 1,000 in 1982, but there had been double-digit inflation for many of those years, so your real value was lower. You lost 75% when adjusted for inflation. And bonds were in a bear market too. Interest rates were, they were near their long-term averages. Their long-term rates were 4 to 6% in the mid-60s, and then they hit mid-teens in the early 1980s. So stocks went down and bonds went down. Commodities rallied and crashed, but most people are in stocks and bonds. There was nowhere to hide. So he came up with this idea of developing a portfolio that could survive anything, any era. High inflation and high growth, you make money. Low inflation and low growth, deflation. Whatever came down the pike, you would be okay. You'd survive. You might not shoot the lights out, but you kind of know where your money was. And so his simple solution was to take your money and divide it into 4 baskets. Put a quarter in U.S. stocks, a quarter into long-term bonds, treasury bonds, a quarter into cash or short-term treasury bills, and put a quarter in gold. Called it the permanent portfolio. It's crude, but it works. And the final portfolio we'll take a look at is a more optimized version. It takes into account that stocks are more volatile than bonds, so to balance them out, you might want a little more bonds. And the fact that gold is a great diversifier because it's not correlated with other things, but there's an opportunity cost to holding gold. You have to pay to store it, and all it does over the long term, on average, is keep up with inflation. But there's no guarantee that gold, like there was inflation from 1980 to 2000, but gold fell from 800 to 250. There's no guarantee with gold, but it's a nice kind of a wild card to throw in there.
So there's a storage cost, and you're giving up a positive expected return.
Yeah, if all you did was keep it in a savings account, you'd earn, you'd be assured of getting more or less the inflation rate after taxes. Yeah. All right, so let's take a look at how they've done. The portfolio 1 again is your mix of various stock flavors. Portfolio 2 is Harry Browne's permanent portfolio. Quarter in stocks, a quarter in long-term bonds, a quarter in cash, and a quarter in gold. And portfolio 3 is a more optimized version of an asset allocation portfolio. So you can see that from 1987 to 2017, Stocks are the winner. They have the highest compounded average return, 8.65%. If you put 10 grand in 1997, you'd have 54 grand today. After that, my optimized portfolio, you compounded at almost 8%, you'd have 36 grand. I'm sorry, 40. You'd have 46 grand. And Harry Brown's portfolio compounded at 6.5%, and you'd have about three and a half times your money, 36 grand. But let's look at the actual experience. Those are just the final numbers. What really matters is the experience, and whether or not you actually got those numbers, because it's hard to stick to a program. It's hard to stick to an investment program. So, from the beginning, 1997, this was a boom time. Clinton's first year of Clinton's second term, unemployment's low, growth is high, everybody's opening Ameritrade accounts, getting online, trading NASDAQ stocks. And stocks were the winners for the next 3 years. They went up 80%. And this is a few years into the bull market. Stocks were crushing it until March 2000, when they got cracked and they just kept sliding for 3 years. I think the S&P, bottom to top tick to bottom tick, the S&P was down by half in that bear market. People have forgotten about it. Everybody talks about 08. What happened in 08? Well, that 08 was it was 55% top to bottom. It was a fairly run-of-the-mill bear market. It was just credit crisis too, and it happened fast. But that was a fairly normal. That was not an unusual thing for the stock market to go through. Stocks will lose half every few years. It just happens. So that happened, and you had a real nasty time. You weren't back to even until 2006, 2007. This is adjusted for inflation, by the way, and it includes dividends. So this was your real experience. You weren't back to even until 06, 07 if you had stuck with stocks. If you diversified, yeah, you watched stocks run away for a few years, but then they crashed back down, and you just kind of treaded water. You were in stocks in these portfolios, so you lost a little, but bonds were doing okay, and gold was doing okay here. So you just kind of treaded water. And then in 03, stocks took off again. This is the Bush era. Everybody's borrowing against their houses. The economy is seemingly booming, and all your portfolios went up. But then stocks crashed, and the others, this is the crisis of 08. This was the worst financial panic of our lifetime, since 1973, 74, really. And these portfolios were only down 15 to 20% in a good diversified portfolio, whereas stocks, the broad market was down by half, and it took years to get back. You weren't back to even until 2012. Whereas these, you were down for a couple of years, a year or two, and then kept marching higher. Much easier to stick with it in a diversified portfolio. And here we are. Stocks have had another great bull run, 8 years, compounded at 17% for the last 8 years. That's a crazy run. And these have done just fine. They've been going up too, but we'll see what happens in the future. Stocks are overvalued. We'll see if history repeats.
So we see that at the end of, from 1997 to 2017, 20 years, stocks the big winner. And there's ups and downs, but at the end of the day, stocks are the big winners. So why shouldn't a person, why should somebody be diversifying? Is it just what is it doing for the investor? Now, what you said was one thing is it's smoother.
Far smoother.
Smoother. So what is the benefit of a smoother curve?
All right. So there are two there are two ways to look at it. Number one is, in reality, it's hard. Psychology is the biggest impediment to doing well as an investor. You would agree, wouldn't you?
It's a huge aspect. Correct.
I think
it might be the biggest.
I think it's the biggest aspect because investing can be really simple. You don't have to be a genius to do well, but it's very hard at times to stick to it. And what makes it hard is experiences like crashes. So if you just avoid, I mean, what's a crash? When you're down 30, 40%, you call that a crash, you call that a nasty drawdown. If you're never down that much, it's really easy to stick to it. You just keep socking money away in your investment portfolio the same as you would in a savings account.
That's very true. I mean, we look at the chart and we think we can stomach these drawdowns because we see at where the end result, we see in 217 that the blue line's the highest, that all stocks are the highest, and that, oh, we can go with these ups and downs for now. And we think we can go with these ups and downs. But living, it's a completely different thing.
Exactly. I often think about the experience that baby boomers have had because they've had such a great run in stocks. They started investing in a really cheap market. The 80s and the 90s were huge bull markets. They never had a really nasty, that was a great run. They had 87, they got whacked, you know, a few bad months and one really bad day, but that's about it. And then until 2000, that was a good 18 years there of a solid run. And then since then, they've recovered from each of these. Stocks are still higher than they were in 2000, even though they're very expensive. But very few baby boomers have actually gotten the index returns over their lifetime because they've traded in and out badly. They were getting in the late 90s, and then they were panicking out when stocks were cheaper, and they should have been getting in or staying in. The same thing. We see this. We've seen this with so many people. They can't stomach the deep drawdowns, and they sell when they need to hold. You don't get this big return if you don't stick with it.
The other thing, so that's very true. Now, we all like to think that we're better, we can stomach these drawdowns, but even if we could, it still makes sense to diversify.
That's right, because it's not, all stocks is not the most efficient portfolio. If you're okay with losing half your money every few years, you can do better. You can do better than the 9% long-term rate of stocks. You can take a more efficient portfolio like this and lever it up. Use the margin available in your account from your broker. You can borrow from a good broker, from Interactive brokers at least. Others maybe not so much, but Interactive will lend to you at 2 to 3%. So lever it up so that your 13, 17% worst event becomes a 20, 30, 40, 50% worst event. If you can take 50%, take a more efficient portfolio. Take that 50% in a more efficient portfolio so that you compound at 15% instead of 8, 9%. You'll double your money every 4 years.
So when the layman hears leverage or margin, they think it's risky. But what we're saying here, if I get you right, is that you can take a diversified portfolio, lever it, and that still will be less risky, or you can take it to the risk level of equities. You
can dial it to whatever you're comfortable with. If you say 25%, I can live with that. I wouldn't aim for more than 25% myself. I can't stomach it. Buffett has lost half his money a few times in his life. Not recently, but he has. And he can stomach it. He just goes for that huge top line. And his system value kind of requires that you accept that deep return, because if something gets cheaper, you just buy more and it can always get cheaper. But the value is a different story. But if you can stomach it, just aim for that. Why not go for a higher return? This will get you a higher return for whatever level of risk you're willing to accept.
So that's the problem with an all-stock portfolio. Even though the headline number is high,
yeah,
you're not on what we call the risk-return frontier.
Right.
And that means that for the level of risk you're taking, you're not getting the return you should or could in an optimal portfolio. And for the return that you're getting, well, if you want a stock-like return, then you can reduce your risk substantially. So you should do one or the other. Either take your risk down or take your return up.
To get that 8-9% headline figure, really after inflation, stocks on average over the last 100-odd years, if you look at not just the US but around the world, stocks have compounded at anywhere between 4 and 7% real after inflation, including dividends after inflation. That's what you really get. So call it 6%. That's not a hard number to get, and you don't have to accept these major drawdowns and the uncertainty of the timing of your returns. There could be long stretches where you're in the hole and getting nothing, and that really matters in reality, because our investment horizon is not 100 years, it's not 50 years. I think for most people it's more like 20 years, because we don't really start saving until, most Americans at least don't start saving in any real quantity until they're in their 40s and 50s. They're high earning years when inflation is, or their retirement is looming on the horizon, then they finally get serious. So they really only have about 20 years. And if that 20 years happens to coincide with a secular bear where stocks are starting out at a really high valuation and then are just treading water for that time, that's a bad outcome. They're not going to have enough.
Right, we look at these long-term return of equities and we see that over 50, 60, 70 years they have these superior returns to any other asset class, but we don't live, or our investing life isn't certainly that long.
Yeah, let's think about somebody. Imagine you're some guy who's 45 in the year 2000, and he's saved up 100 grand, and he's going to put away another, say, 20 grand a year because he's earning good money, and he's running the numbers, and he says, well, stocks pay 10% a year. My money's going to compound at 10% a year. He plugs it all into a calculator, and he says, I'll be fine. It's at at age 60, I'll be fine. 65, I'll have such and such. But look at this. 12 years later, in 2012, it's 2012, and he's only got what he's put into it. He would have more money if he put it into a savings account. And that's if he stuck it out through these two nasty bear markets. There's this uncertainty. Well, forget 45. What if somebody's 65? What if they retire here and they keep everything in stocks and they're spending 4% a year while stocks are going there? They've spent their entire retirement portfolio over this 12-year period. A lot of people would have done that. Whereas if they'd gotten in here, or if they put it into a more diversified portfolio, they would have had a positive return. What a diversified portfolio return does for you is it gives you a higher likelihood of a positive return or a good return, much higher likelihood of a good return over an investment horizon that matters, whether that's 5, 10, 20 years. Whereas with stocks, it's a wild card, and it depends so much on just mass psychology, the magnets of crowds, and your starting valuation. But you can plan better with diversification and lower volatility.
So should we put the lights back on? Are we done with the chart for now?
Yeah, we've shown it up here.
I think we're already 15 minutes into.
Go ahead and yank the plug.
This one here?
Yeah.
So I think we're 15 minutes in, so we should probably cut it soon. But let's just do a quick review of why how diversification is helpful. How it's one of the big methods of beating the market, or why it's the cornerstone of investing. So one is...
I'd say it's the easiest way to beat the market.
It's the easiest way to beat the market. Anybody can do it.
Anybody can do it.
There's one thing that we didn't touch upon, is that you have the different buckets, but what percentages you put into each one. that's, you know,
you want a balanced portfolio, and some assets are more volatile than others. So there's this concept of risk parity, where you want to match the risk from different assets. So stocks in general are twice as volatile as bonds. So to balance out 100 grand in stocks, you ought to have 200 grand in bonds. And they move inversely, which is ideal in a diversified portfolio. When one's going up, you want the other to go. When one's going down, you want the other to go up.
Well, you really want things to be non-correlated.
Non-correlated. Well,
right?
If you only have two, you want them to be inversely correlated.
But how do you get ahead?
Well,
if you're perfectly hedged, how do you?
They're not. It's not a perfect -1 correlation. I think the stock bond correlation is like -0.5, 0.6, something like that. It changes over time, but bonds will go up over time too. It's just that they tend to pop when stocks are going down, and they go up at a more muted rate when stocks are really rallying.
So it's a nice stabilizing effect.
Sure.
Which any extra diversification you can get at that moment in time, it creates a stabilizing effect.
Yeah, the ideal is to have, you know, a bunch of uncorrelated assets. There's no correlation between them whatsoever, and they all will go up. If you pick any one of them and hold it for 20, 30 years, you'll make good money. But the pattern will look completely different from any of the others. That's ideal. But that doesn't exist in reality. We all have, you know, correlations come and go among these assets. So real estate is pretty positively correlated with stocks, and bonds are negatively correlated, but not perfectly. The only perfect negative correlation in the markets is hedges. If you short the market, or you sell a futures contract, or you buy puts.
Now, some of the academics will tell you that that's impossible to do to time the market.
That's market timing. It's not exactly the same thing either, because there's a cost to it. That is a hedge has a negative expected return over time. I mean, buying puts is a guaranteed loss of capital over, you know, multi-year period.
Right.
Just it'll pop once in a while when stocks fall.
So that's a different skill set, which we'll cover in one of the episodes, but for the...
and it's really complicated, but just to get back, just plain diversify.
But anybody can diversify.
It's as simple as saying I'll put X, you know, I'll put this much in healthcare stocks, and this much in consumer staples, and this much in utilities. No, you just put this much in the S&P, and this much in Japan, and this much in long-term treasury bonds, and this much in corporate bonds, and a little bit in gold, and a little bit in REITs, and you rebalance every year. The same, you fix your percentages and you rebalance every year. That's diversification, and it's so easy. Heck, you don't even have to optimize. Forget my optimized portfolio. Just do Harry Brown's, or do called the 1/n. Pick your 5 buckets, right, and just put 20% in each. Or your 10 buckets and 10% in each. Just make them different asset classes.
So that's true. That's true. You've shown us why that's effective, and that philosophy is, I guess, the foundation of why these robo-advisors are coming around, because you pick your buckets, you pick your percentage allocation, and then it does it, I guess, robotically.
Yeah, robo-advisors are like index funds. They're a great step in the evolution of investing. Index funds guaranteed you the market return, the index return, whereas mutual funds were a good step too. Mutual funds, I'd say, in today's market are horrible. Nobody should invest in mutual funds. You have sales loads, which can be 5%. It's criminal. You have high ongoing annual fees for discretionary management that ends up being like the S&P, but a little worse on average and a little bit random. And but it
served a purpose in its time.
But they served a purpose in their time, because what they were still better than having to call up your broker and pay 1% per trade.
It was very expensive to trade.
And how do you don't have access to information really in the 1950s, 1960s unless you're Warren Buffett mailing in and requesting 10Ks and getting S&P's big book and wading through all that paper. So yeah, you could just send a check to Boston and your money was safe, and you more or less got the stock market. It was a professionally managed portfolio, and you got the stock market. So that was a step in the right direction. Index funds were an improvement because you were guaranteed the index and it was cheap. You saved a percent or two a year, no big sales lows or anything. Vanguard is a wonderful company with good people. It's really rare in this industry to find a company, an investment company, a big investment company that puts their clients first. And I've been impressed by Vanguard. They do a great job, and we use a lot of their funds because they're so cheap. They do things right. So that was another step in the right direction. And these robo-advisors are then cutting out the advisor, who most advisors don't earn their money. They charge, 1, maybe 2% a year, and they're really just replicating the S&P or rebalancing a 60-40 portfolio. That's not really a value add, and they're charging exorbitant fees for it. They're not okay, maybe they're helping people save a little on taxes with structuring their investment, their retirement accounts right, but it doesn't seem worth it today. So the robo-advisors will do all that for a quarter of a percent a year. That's great.
So it's an improvement upon this series of improvements that happened in the market. Say, 100 years ago, we just had just stocks.
The beef I had that I have with the robo-advisors, it's not really a beef, it's just a suggestion, is that they need more asset classes. They have stocks and bonds. It's the basics, but and they don't take into account valuation. Indexing is all the rage, and we'll see what happens in the bear market, in the next bear market. But they don't let you put together a true asset allocation portfolio because they don't offer commodity funds. Maybe they'll have limited international funds. So maybe limited REITs, if any. It's really just stocks and bonds still, but they'll probably evolve.
I'm sure they'll evolve. They'll have other. So it's. I'll tell you what I think's good about it and what my beef is with it. Mm-hmm. What I think is great about it is that it's a quantum jump in improvement for the individual investor from the days of, hey, Mr. Ritger, this is BKM at Howie, Cheatham and Moore, and I got a great stock for you. And most people, I think 40, 50 years ago, that's how people invested.
Yeah.
Today you have multiple asset classes, diversify asset classes, and you can really give yourself a chance to win with your real money.
Yeah.
I don't know if that gambling instinct is going to go away completely, but instead of being 100% of a person's portfolio of that hot stock, it's going to be just a fraction of it.
Sure.
So that's a great thing for the individual investor. Now, me coming out of a trading background, I can't do anything but just buy and hold and be blind to. I know everything goes up and down. I do believe that you can do very effective things that some are simple, some are complex, some take years to develop, some maybe you can take at face value like diversification, to do little things to beat the market. So I do believe in, I don't know if robo-advisors are ever going to do that. I don't know, they certainly don't do it today. I don't know how that would work.
From what I can tell, they're investing, the investing theory they're following is, they're up to about 1995 maybe.
So, but for in the context of this segment, this episode, this probably brings diversification is the foundation of investment, and that's the foundation of this latest improvement in the investment world.
Absolutely. There's no reason not to diversify beyond just U.S. stocks or your home country stocks. It's the easiest thing to do. It drastically boosts your risk-adjusted returns, which you can then lever up to become much higher returns if you so choose, or just, well, I'm confident in saying that over the next 15 years, a risk-adjusted, an asset allocation portfolio is going to trounce the S&P 500 because it's starting out right now at such a high valuation. Just like the risk, if we had showed that chart starting instead of 1997 in the year 2000, we're in a 2000 type environment right now in 2017. Our valuations are that high. A diversified portfolio is going to blow the S&P out of the water for the next 5, 10, 15 years, which that matters. It matters to a lot of people for a lot of reasons.
Well, it matters for retirees that can't contribute to their investment programs, so they can't smooth out their drawdowns through contribution. Mm-hmm. It matters for universities or endowments or organizations that have to meet certain expenses with their capital.
Yeah.
It matters for the psychology for anybody. Mm-hmm. And even if you're a super aggressive trader or investor, diversification puts you on the optimal frontier.
Absolutely.
And the other thing which I didn't appreciate was diversification gives you you don't have to be so smart to get diversification right, and it gives you a chance to I don't want to say it guarantees that you win, but it gives you a really good chance of doing well.
Yeah.
Whereas
over any given period, it gives you a far better chance of doing well than the stock market.
Right. Or picking that one investment that's going to be the home run.
By the way, I heard recently a statistic that 58% of individual stocks, listed individual stocks in the U.S. have gone to zero. How about that?
What's what do we say in capitalism? The destructive force of capital. What was it? The creative destruction, right? The creative destruction of capitalism. Most stocks have to go to zero.
Yeah.
How many stocks in the S? We don't have to cut this short. I think 15 minutes ago we said we were already at 15 minutes. But how many stocks are in the Dow from 100 years ago? I think like 3, like ExxonMobil, which was Standard Oil, General Electric, and maybe one other, I don't know.
Yeah, if the Dow drops them, you better drop them from your portfolio. You don't write them down.
That's right. So, is there anything particular you want to highlight about diversification for right now?
No, that's it. It's just it's a free lunch. There's no reason not to do it. There's no cost. It's easy, and it gives you more stability, more confidence in where your money's going to be over any given period.
Thank you for watching this episode.
Talk to you next time.